Hello, everybody. This is Bob Woosley with FD and FD Fund Administration. Welcome to this edition of Private Equity 360. And this is one I've really been looking forward to, talking about real estate and what's been happening to our industry in this pandemic. Before I introduce our guests, we've certainly had a lot of conversations with our real estate funds where we do administration on that. This really been a mixed bag, but we've got two great experts today to give us their read on what's going on. I'd like to introduce them right now. First, I'd like to introduce Jeff Klein, who's the CEO of SVN SFR Fund, a real estate fund, which he'll tell you a little bit about. And I'd also, by the way, Jeff is located in New York. The fund is located in New York City. I'm joined also with Jeff and with Brian Adams, who's the principal and founder of Excelsior GP, a great organization in Nashville, Tennessee. And Brian has done a lot of speaking on this subject. We're really happy to have both of you guys here. So first, before we get started, let's just go ahead and have you guys give a brief introduction of who you are, where you fit in this industry, and then we'll go into our topic. So Brian, let's just start with you first.
Thanks, Bob. And I really appreciate you having me on. This will be a lot of fun, I think. So I am a New Yorker who married a Nashville girl. I've been in town for about 15 years. Started my company 10 years ago, and we've gone through different iterations of the business, but our main focus is now syndicating equity deal by deal. So we raise capital from individuals, family offices, and independent RIA, boutique wealth management firms. And we focus on commercial real estate, typically multi-tenant office. So we have about 2.5 million square feet total under management today, and we're in 12 different markets, all what we call secondary growth markets. So think million plus MSAs, but not the top 10 traditional gateway markets, places like Nashville, Kansas City, Raleigh, Tampa, et cetera. And the way I try to present this is we do three things. One, preservation of capital. Two, we produce a nice yield for folks. And we do a lot on the tax side, actually, which is how I connected with Kim and Bob originally, to really accelerate the benefits of direct real estate ownership.
Jeff, introduce yourself and tell us a little bit about your view, your position, your firm, and your view on the marketplace.
Sure. Good afternoon, Bob, and thank you as well very much for the opportunity to be able to participate today. We really appreciate your series. Have been absolutely fantastic during the pandemic, so we appreciate all the extra work that it takes from a production and time standpoint to put these great programs together. Great discussions. My name is Jeff Klein. I'm the CEO of the SVN SFR Capital Fund 1 LP, which operates out of New York City. We also operate 4 additional companies in the SFR portfolio, single family residential rental home portfolio space, as well as the BFR, or build for rent portfolio space. We lead the nation from a national transaction standpoint. We operate a brokerage that is dedicated to this space. Secondly, one of the top data research and valuation companies. And of course, the fund that I currently lead, which is a new fund that is just launching as we speak between now and Q4 of 2020, which is an acquisition aggregation fund. We are just finalizing acquisition arrangement with builders on about 4,000 built-to-rent homes, which are dedicated communities that will be single-family, attached and detached communities in top 22 MSAs.
For the listeners and viewers here, notice we have a plan. We have residential and commercial viewpoints here, and I know you guys have probably views on all the above, but let's just jump right into this crazy pandemic and what's been happening. And I'm certainly going to give you my thoughts and hearing from other real estate funds and investors, but obviously a crazy time. Brian, can you give us just a flyover of what you're seeing, maybe what's happening to prices or activity? What are you seeing right now? And then Jeff, will go to you next.
Yeah, so it's really a continuum in terms of on the commercial real estate spectrum, how badly people are being punished right now. On one end, you have hospitality, retail, bar, restaurants, which are just getting hammered. Office is probably somewhere in the middle along with multifamily, and it really depends on what your user profile looks like and what exposure they have to COVID related businesses. And then you've got really insulated businesses, or even some that are doing very well, which would be in the industrial distribution, self-storage, data center, cell tower type world. But on some level, it's a bit of a continuum. If things continue to digress, we're all going to be hurt. But for now, that's kind of where the pain is being felt most acutely today. We have had about 93% rent collection month over month since March. And that's pretty average for us. We have had a number of users have some issues, ask for rent relief, et cetera. It is difficult to get a pulse on whether those rent relief requests are opportunistic or a true need. And so we've put in some systems internally and worked with some of our advisors to have a plan to address those needs and to kind of ferret out whether or not it's, a true request or not. But, frankly, office feels like, it's in a decent place right now, unless you're in one of the big coastal markets. But again, I think it will take a while. And Jeff can speak to this probably better than I can. I assume he's been through multiple cycles, but I think it's really going to be Q4, Q1 until we get a full sense of what the damage is, because just from a foreclosure servicer process wise, I know from some of our conversations with CMBS servicers, unless it's hospitality or retail, they say, call me back in 30, 60 days. They're triaging what they're dealing with. And so I really think it's going to be Q1 until we get a full sense of what the damage is.
And Jeff, before we get to you, both you and I will not be insulted by Brian.
that
was guys.
That was
going
not
through several cycles. It's okay.
That was not a shot,
but,
Jeff. I'm speaking to your sage wisdom. Yeah.
I'm on cycle number 96.
It's all good. Yeah. Other than being insulted by Brian, just kidding. Jeff, why don't you go ahead and tell us what your viewpoint is from your seat at the table?
Sure, Bob. It's really been interesting and really almost fascinating over the course of the last few months, kind of during COVID. It's in that how residential rental housing has really dovetailed into commercial office investment segment, as well as the retail segment. So it's kind of interesting, as well as multifamily, obviously. We've seen, what have we seen during COVID since, say, mid-March of this year? From our brokerage company aspect, we've seen about a 650% increase in onboarding volume. So we're seeing mom and pops, as well as institutional investors bringing assets to market just because they're not sure of what's going to happen and what post-COVID may bring. Number one. Number two, it's been interesting because now the interconnection between Bryant's main segment, which is commercial office building product, with homes. Obviously now, instead of being in the office, it looks like we're all, literally the three of us, are in our homes today, still in our homes, and yet to be determined on how long that's going to continue. But the new normal is going to be new. I think the industry and just general economic situation has accepted that. It's something new. We don't know exactly what it is. So my point is that home living and home working, all of a sudden, just the last 3 to 4 month period of time, has become much more important. So we've seen several shifts. Number one, from the investment standpoint of office building investors, say, coming from Brian's majority segment into single family rental home portfolio investment, just because of its stability. It's been proven since April 1, very high rent collections. It's been ranging anywhere from 95 to 98% rent collections, which is one of the highest commercial real estate investment segments in the country. And then secondly, from a other rental product occupancy standpoint, people seeing a need or want to move into a single family rental home rather than a multifamily apartment. For the obvious reasons, multifamily apartments are dense. You've got neighbors, you have hallways, you have elevators, You have no yards, no open space typically, or limited open space. So there seems to be a real strong second and third wave, potential new single-family rental tenants. And that's because of the change in office and the change in retail. So it's kind of interesting is that those two commercial real estate segments have really just force-fed an immediate overnight change in how and where we live and work today. One other point I might mention is that we've seen in many of these panels that we've either watched or participated in over the last couple of months, there seems to be some real industry insight as to suburban coming back, so to speak, in that as we start to learn what the new normal may be, where the individual professional service person employee may be now only going to the office once or twice a week, or maybe half days or whatever it might be, rather than 5 or 6 days a week. So as a result, we're starting to see in metropolitan areas, or the industry believes a migration back out into the suburbs because that 1 hour commute versus an in-town half an hour commute now all of a sudden isn't so bad if you're just making it once or twice a week to go into the office rather than every day. So many changes are occurring.
Jeff, when you briefed our team about what you're doing pre-pandemic, we thought you had a great concept, and we hadn't seen it before. We work with mainly funds or in commercial real estate, industrial, infrastructure, and man, as the pandemic started occurring, I was thinking about you and how every one of those value drivers would be accelerated. And maybe that's a good segue into all the trends in America that were starting to happen. And, as you read about it, every trend that was going to happen over the next 3 years is happening in 3 months. But Brian, you and I have talked a little bit about, and your focus on secondary and tertiary cities, kind of piggybacking on what Jeff said, going out to the suburbs, but also going away from the major cities and spilling out into rural America. There was an article in the New York Times recently about that. That can be a really good thing for our country to spread business opportunities and investment across the country. Brian, what's your view on that? And maybe react to what Jeff just said.
Yeah, I would echo Jeff's comments. We've seen the exact same thing. And, Bob, to your point, it's almost cliche or hackneyed at this point, but it really COVID has accelerated these trends that we've been forecasting for the last few years. So today, millennials, it's roughly 75 million people total, largest working population cohort in American history. I think the narrative on Wall Street, or for a long time, was that these folks, and I barely qualify, but that this kind of population group would never have a family, they'd never get married, that they would live in Brooklyn and eat avocado toast and wear skinny jeans for their entire lives. But the reality is, because of 2008, that family formation phase of that generation was pushed back about 5 years. And so they are starting to have children, and COVID is really accelerating this trend that we started seeing from a migratory demographic shift, where this population is now making choices about where they want to live, work, and play based on exactly what Jeff was talking about: access to education for their children, access to single family housing, quality of life, cost of living. And when you put all of those factors together, secondary markets, and more acutely suburban submarkets within those secondary markets, check all those boxes. And so you've started to see this just massive influx. And I think what you'll continue to see is this is an employee-driven shift to a hub and spoke model. And the employees are already doing it. Employers are going to quickly see that in order to attain and retain that human capital, that workforce population, that's their most vital resource, they're going to have to start expanding their footprints in these markets and within those suburban, what I would call kind of nodes, in order to stay relevant in the business atmosphere.
And Jeff, what's your view on what Brian just said? Do you agree with that?
Yeah, I agree 100%. It's interesting because it's probably a once in a career or once in a lifetime opportunity that we've had over the course of the last 3 or 4 months from a business standpoint, because there seem to be so many shifts occurring all at the same time. So it's hard to identify each and every one, obviously, because they're all happening in each commercial real estate investment segment. And I'm sure Brian will speak to the fact, and it's something that as I've reached out to cohorts in the industry is, and we're certainly no exception to this rule, in that from an office space standpoint, it seems like there's going to be a real, I don't believe office product or asset type is certainly dead. I think it's just a reconfiguring opportunity, obviously, at this point, because not unlike ourselves, as a result of the success of remote working, that can or may require less office space depending on the employee positions and responsibilities. But it's certainly an opportunity for, I think today at least, a couple of things that may happen or are happening is that you see the, whatever the square footage may be, the 20,000 square foot user relocating into a 15,000 square foot space or 10,000 square foot space. You may see the smaller users that prior was in a temporary or daily or monthly space similar to a Regus or rework, actually taking advantage of the reduced cost of office space and relocating into a permanent office. So I think there's just a million different shifts that we'll see occurring over the course of 2020 and 2021, and certainly see, in all product types, no matter whether it's retail or office or multifamily, it's a shift and it will just reconfigure. So I certainly don't see any of those investment categories being dead, so to speak. They're just going to be repurposed and repositioned.
You mentioned an interesting word, and Brian, I'll go to you in just a second. You used the word opportunity. And one of the themes for the last several of these episodes is in every disruption, there's an opportunity. And we're seeing some funds. I have one fund that we know real well, about $8 billion fund, that they have one team playing defense and one team playing offense. So the defense is what you're talking about, Brian. It's triage. The offenses go, you know what? There's opportunity out there, and we've got dry powder, and let's go. And maybe we can kind of, as we're circling around the bases here, heading to the end of this episode, maybe we can talk a little bit about the investor psychology here, the investors that you have in your funds and invest in your deals, Brian. We have our hand on the pulse of a lot of institutional investors. What are you feeling the investors are seeing when they're watching, firms like you think through this market? Brian, what are you seeing from the investor side? And then we'll go to you, Jeff, and then we'll kind of go through some concluding remarks. Go ahead, Brian.
Yeah. So the bulk of my investor base are individuals and families. And like all individuals and families, they can be a bit schizophrenic at times, just like I can. Certainly in March and April, there was a lot of fear. There was a lot of anxiety. The world was falling apart. Office was a dead asset class and everything was going to change. Certainly not the case. So today, what I've been seeing for my investor base is the stock market is scary. There's a lot of volatility. It's extremely expensive. And it seems like it's been driven by this big tech push. There's all this liquidity being pumped into the system by the Fed and Congress. And seemingly it's had to go somewhere. So it's gravitated towards stocks and bonds. So yields are terrible. Stocks seem expensive. We seem to be in a very long-term low interest rate environment where the Fed is trying to prevent deflation, comfortable with possible long-term inflationary dynamics. And when you take all that into account, I think real assets on a risk-adjusted basis still makes a lot of sense if you have a long-term horizon. So I've seen a lot of individuals and families start to call and ask if I'm seeing more deal flow, if they could participate in the next offering. I've seen a lot of activity actually in the SFR space where Jeff is, and we can talk more about. I think there's a lot of parallels between the density conversation happening in office and the density conversation happening in residential, where I think there's a lot that we could kind of piggyback on each other. But that's what I've been hearing from my investor base is they probably have experienced, an upswing in where they are from a market investment, and they're maybe looking to take some chips off the table, de-risk. But at the same time, you're punished for holding cash right now. Money market returns are terrible. Everyone's worried about inflation. Taxes are still real, and taxes, unfortunately, no matter what the jurisdiction is, because of COVID, taxes are going to go up, right? So they need some kind of income driven, inflation protected investments where they can also get some great tax benefits. And that's where I think real assets, have a really big part to play moving forward.
Jeff, what's your view on your investors? I know you're right in the thick of it right now with your new fund, and you probably have a pretty good handle on it. So
yeah, we sure are.
Your investors?
Literally hour by hour, day by day, which has been pretty, again, fascinating in that in the SFR and BFR build for rent space, it's been a very active space during COVID, as you've seen in the Wall Street Journal. There's been several $100 million capitalized from an equity standpoint by a lot of the big Wall Street firms. That started on April 15th, which was just really 2 or 3 weeks after the pandemic had put us all at home. And it started off, immediately with capitalization into this space. Now, one thing that's been kind of interesting, so from a capital raise standpoint, we really believe that accidentally the timing on our fund has been absolutely perfect because capital is pouring into the SFR investment space from other commercial real estate segments because of the stability, obviously.
Yeah.
So very fortunate and grateful from that standpoint. The one point I might mention, which is kind of interesting, Brian mentioned the many cycles that I've been through. And I was just comparing the other day in a discussion I was having with the 9/11 cycle and 2008 cycle. So it was interesting, the beginning of April, the first and second week in April, we noticed as we were speaking to clients on our brokerage end of the business that we started to see very immediately $1 billion of capital calls on subscription agreements with various private capital groups to buy distressed property. They anticipated distressed assets would immediately become available. And literally that has not happened in the SFR investment space to date. Yeah. In fact, valuations have either stayed stable level or actually increased in some MSAs. Now, that's not to say that we won't see some distress in this particular investment segment somewhere down the road, but it certainly has not happened yet. So it was interesting because some pretty sophisticated investor capital groups literally called several $1 billion that we were up to be able to just jump on the immediate distressed opportunities, and there's been really zero to date.
Well, gentlemen, I think this has been great. I would encourage anybody listening to this to, we're going to have your contact information after this, but you guys are really representing, two, entrepreneurial, viewpoints on this. You're seeing opportunity. You're not your run-of-the-mill, fund doing just normal stuff. I think your nimbleness and your read on the marketplace is going to serve your investors very well. So I encourage everybody to investigate, reach out to you, connect to you. I think it'd be worth everybody's time. And with your permission, I'd like to maybe find time, maybe 4 or 5 months from now, to come reconvene with you guys and do an update. I think a lot's going to happen. Sure. Maybe we do it maybe after the election, for example, to see, and bring in, what the political environment's going to mean to this. Because to your point, Brian, on taxes, that's probably going to influence that a lot in terms of where we end up on that. But with your permission, any closing comments? I've just really enjoyed this. This is exactly what I'd hoped it would be. You guys are great. But Brian, any last comment from you? We'll go to you, Jeff, and we'll close it up.
Yeah, I think I'll kind of make one comment about the density issue in terms of, and I think Jeff is exactly right in terms of, the question of, is office a dead asset class? Or it is not. It's a viable, resilient asset class that's been around for multiple cycles, 9/11, 08. But I do think fundamentally the way that we use office will change. So in some of these WeWork locations, density was down to 75 square foot per user. Traditional office layout is more like 250 square foot per user. So just like what Jeff is seeing with, people going away from the density of multifamily to more of that open space plan, single family home. We're seeing the exact same thing from a user standpoint on employers who want, frankly, a lower cost option to a dense office building in Manhattan versus suburban office building in a secondary market. But that allows them to have that kind of density and flexibility of how they use it. And I think an important aspect that people don't talk a lot about that also impacts Jeff's business is these are all car-centric cities and car-centric markets. And the ability to park that density on both a residential and an office commercial usage is going to be key moving forward.
Jeff, any final comments from you?
Yeah, I believe, and I agree with Brian 100%. One benefit that we have being part of the SVN network, which operates about 200 offices nationwide in the commercial real estate brokerage business. So we just have extreme access to what's going on in every commercial real estate segment, even though we're dedicated in the SFR rental home investment space. But it's been interesting since the beginning of April, the amount of activity that's occurred in literally every segment, including even hospitality, industrial, multifamily, retail. It's really been impressive. So none of the commercial real estate segments are dead. We're all in reconfiguration, obviously, mode. And like you mentioned at the top of the discussion, Bob, that always, and for all of the many cycles that I've been through, it always creates huge opportunity for the individual that's willing to work hard and get out there and get it done. And thank you very much for the opportunity to participate today, Bob. It was nice to meet you, Brian.
Yeah, that's a great way to end this, Jeff. Thanks to both you guys. I really appreciate it. And thanks to everybody listening today. And we'll go ahead and conclude this episode of Private Equity 360. Thank you.
Thanks for listening to one of Frazier & Dieter's branded podcasts. To learn more, connect with us on LinkedIn or visit us at FrazierDieter.com and be sure to subscribe so you never miss an episode.